It's a pretty calm day today in the stock market. And if you didn't know that tomorrow is Liberation Day, according to President Trump, the day we put tariffs on imports across the board, you would just feel that today was a pretty good day. You know, some stocks went up a little, some stocks went down a little. It was actually it was actually a pretty boring day, but this is exactly what we've been talking about. um, and I just posted a snippet about it. So we've been talking about in the live stream for the last few days. We had that swoosh down on Friday, but yesterday was a calm day. And, investors don't want to move. They're not buying, they're not selling. We just want to see what the tariffs are going to look like. The stock market is kind of probing, testing its lows to see if it should go lower or to see if it could hold the lows and maybe have some kind of near term bounce. And that's what the market's waiting for. It's marking time. So we'll talk about this real quick. The Bureau of Economic Analysis, a official website of the U.S. government. We're going to show you that as well. All right. So let's roll the intro, and we're going to talk about even if we tariff every import that comes into the United States, I'll show you exactly why it won't make a dent in paying down the deficit. Here we go. Thank you for having me back. My name is Mitch Goldberg. I'm with the wealth management firm Client First Strategy. And what we do here is we help our clients prepare for the future financially and quite a bit emotionally as well. And I think the most important thing we can do is find your glide path, that point in your life when you start turning your investments from the growth bucket to the income, to stability and income. It's not an overnight process. It's something that happens gradually. It's some of the things that we do for our clients. And we answer questions like, should I use home equity to pay for my child's education? Should I buy the second home? Should I have a family trust? These are the kinds of questions that we answer daily in our client conversations. We don't really talk about the stock market and economy all that much because you're bombarded with that stuff. But I do have an idea of what the stuff is about, considering I've been a business owner for 20 years and a financial advisor for 35 years. I've got a lot of experience, and I've seen all kinds of clients overcome all kinds of challenges. So that's our value. We help people overcome their challenges. We've done it before. We can tell you how to do it, and we can tell you how they did it themselves. And it's a lot of knowledge. That knowledge base is what our clients value us for. Okay, so the major averages today were kind of flat. I don't even have to show you. The Dow is off 11.8 points, which is a blip. S&P was up 0.38%. NASDAQ up about 0.9%. Small caps were basically flat. And the 10-year yield was basically flat. It went out at 4.16% today. By the way, you can't invest directly into an index like the S&P 500, but you could invest into a security that tracks or mimics an index. There's a distinction. We have to make that known. So today was a very ho-hum day. And if you didn't know that we were looking to have some kind of D-Day tomorrow, Jerry, my man, how you doing? I hope nobody hijacked the live stream today with some funky videos or something. All right, we talked about that. Jerry's my man. I'm going to be in Florida the 14th to 18th. Jerry, I understand you're going to be in New York when I'm down there. So we're just two ships crossing in the night. In any event, it was a flat day, but this is like a normal day. Just averages up a little, down a little. No disaster. Some stocks up a little, some stocks down a little bit. And you wouldn't realize if you weren't following the news that tomorrow after the close of business is more or less D-Day for the new economy. Is President Trump going to remake the economy kind of like a Reagan moment? Is he going to wreck the economy? Now, I know that when you change something drastically, it's scary. So everyone's coming out of the woodwork saying how bad this is going to be and how terrible it's going to be. Smoot-Hawley helped push us into the Great Depression 100 years ago. That was putting on tariffs, and it just crushed demand. That makes a lot of sense to me, and I want you to know I am in that camp that the tariffs are going to be bad. And you might get people, it's going to cost consumers more money for things. That price increases are passed on to the consumer. And if the consumer decides I can't afford something, then they'll cut back on consumption. So maybe they'll pay an extra $4 or $5 or $6 or $8,000 more for a car. But that also means that maybe those consumers will cut back on a vacation or cut back on going out to eat. Because, the money has to come from somewhere, and wages just aren't growing quickly enough to keep up with inflation. So you add even more price increases on that. It's even more stressful on the consumer. But let's be open-minded. Let's be open-minded to the possibility that maybe President Trump and his administration, maybe him and his administration are up to something that's really good, and we just don't have the foresight or the vision to see that. Maybe it'll be a blip for inflation as the last round of tariffs were during Trump's first term. It could be. No one is a fortune teller. I don't think this is going to be good. I think there are better ways to go about tariff policy. I think maybe tariffs could have been raised 3 or 4 or 5%. And then, and then maybe next year do it again, and the next year and the next year, and give us time to adjust our supply chains. Remember, global supply chains have been developed over the last 50 years. We're not going to change them on a 30-day or 60-day delay for tariffs. We talk about semiconductor plants, about making them here domestically. A semiconductor fab where the chips are assembled is just one part of about 1,000 parts of making a semiconductor chip. The chemicals have to come somewhere. They come from somewhere. The minerals, the elements, there's so much that goes into making a chip that even if you have all the foundries, the assembly plants in the United States to put the chips together, the materials for the chips are still coming from somewhere else. They're still partially made or refined in another part of the world. We can't just refine every single chemical in the world that's refined. We're just not going to do it here. A lot of this stuff is low margin stuff, and it really doesn't even make sense for us to do it. So we outsource it to countries that are more efficient at it and who want that low margin kind of business. But maybe there's something good in it. Maybe, companies will really build these plants that they've committed to. I think a lot of companies that said we're going to put up a $1 billion or $10 billion plant or spend $100 billion in the United States in the next couple of years, I think a lot of them are going to assess and study the impact on everything from environment to their bottom line to everything they could think of for a couple of years to see what the political climate looks like. Because in less than 2 years, we have another election. House of Representatives and most senators come up for re-election. We don't even know if the tariffs are going to be around. And the tariffs are not a constitutional law. They are simply at the pleasure of whoever the president is at the time. So maybe another president might reverse the tariffs in a couple of years. And then companies that built production plants and assembly plants in the United States might regret it because now they have super high cost plants and manufacturing in a world that only wants something cheaper. So the business will go back to some manufacturer in China. It's also causing our allies to look up. Hey, Bobby, good to see you, buddy. I'm so glad you're joining me. It causes our allies to make alliances, both trade and political and military, with other countries as well. But again, maybe there's something good to come out of the tariffs. Maybe we're all wrong, and maybe the money will be really good. But if you take a look at this, screen froze when I did that. All right, so we won't do the share screen. But I'm looking at the U.S. Bureau of Economic Analysis. It's an official website of the U.S. government. And on that, you will see that total imports into the United States last year for 2024 was $4.1 trillion. So if you put a 20%, if you put a 20% tariff on all of that, all right, it's about 800 billion. That's a lot that consumers are going to have to spend, American consumers, out of pocket. And not all of it is going to get hit with a tariff. Maybe it'll be less from some places, more from other places. But you're talking about millions of products coming into the United States and different degrees of finishing, refined chemicals, semi-refined chemicals. The point I'm trying to make is that even if you tariff everything, and keep in mind of that thing, the deficit, it's not all hard products. About a quarter of it, almost a quarter of it, is services. So how do you put a tariff on services? So if you put a tariff on everything that's manufactured or made or mined coming into the United States, it's still not enough to make up the $2 trillion a year right now, because in 2024, we had a $4.9 trillion GDP, but we had to up the deficit by $2 trillion to keep that GDP. So I think that the problem here is that the tariffs, well, we went into it. I think the problems are, it's a really tall order to think that putting a tariff is going to pay down our debt. And if it crushes demand, we might collect some money in tariff money, but it's coming out of your pocket, my pocket. If that means demand goes down, we're going to be buying fewer things, and eventually it equals out, and we hit a new equilibrium with more tariffs, more inflation, but we don't get the benefit because it's fewer products sold. It puts the Federal Reserve in a quandary, in a box, because the Fed wants to fight inflation, so it has to raise rates. Tariffs are inflationary. They become deflationary after they're inflationary, by the way. What happened 100 years ago is we had rampant inflation, but then when everything slowed down and people stopped spending money, people had no money, and the dollar became worth very little, all of a sudden business got crushed, the economy got crushed, and we had years of deflation, which we couldn't pull out of until World War II. And we had a whole new global order, and the rest is history. So tomorrow after the close is when tariffs go into effect, and April 3rd, we start collecting. Now, a number of Wall Street strategists are saying they see, a 30 or 35 or 40% chance of recession. I don't know what that means. You could come out and say, there's a 1% chance of recession. And if you have a recession, you get to say, well, I told you that's a possibility. I did say 1% chance, and that happened. I don't think anybody could really call it. My sense is it's going to be pretty dangerous in the way that we expect it to be, the tariffs. But nobody really knows what the policy is, because there's been, Trump has made something like 70 or 71 tariff announcements since he's president. So we don't know what it's going to look like. We hope that cooler heads prevail, and we'll see. And that's the best I can tell you. All I can tell you is, if you're a long-term investor, stick to it. If you are on a glide path where you're starting to move your money out of growth and risky assets into more stable assets and for income-producing assets, because you're getting closer to needing that money to pay your bills in retirement, you should already be doing it. And that's really more of a matter of personal finance, no matter who the president is and no matter what the tariff policies could be. If you want more information on that, give us a call, reach out. I love hearing from you, and we would be happy to help you. And that's about it. I'll be back tomorrow, and we'll see what the world looks like. But I have a feeling we're not going to really see many things change until Thursday, when we start to get because we already have a real idea of what the policies are from Wednesday night, and we get to react to it Thursday on the open in the stock market. Thanks so much for watching. Have yourselves a lovely evening.